David Rodriguez, quantitative strategist for dailyeffects.com. I'm here to take you through kind of what we're watching in the week ahead, and it's promising to be a pretty big one because it's a lot of what we were talking about last week. It's a lot of continuation in just the ongoing emerging market turmoil and kind of the contagion that we've seen to more developed markets. The fact is that we could see some big market moves, and further to that point, this week actually promises 3 central bank meetings, major central bank meetings, in addition to a few emerging market central bank meetings, as well as a highly anticipated U.S. non-farm payrolls report. So realistically, we're watching for pretty big FX market moves, and in fact, that's exactly what I want to talk about today. And let's start out with, well, happy Monday. But beyond that, let's start out with what are we watching? Let me switch over to some charts. Bear with me one sec. Alright, you should be seeing my screen right now. And on the top headline of dailyeffects.com right this moment is the article which I've just published. It says, huge week for markets, warrant big dollar and yen moves. Well, I mean, it tells you most of what I'm personally watching for. Namely, it threatens to be another big week for the dollar, big week for the yen. And in fact, that's exactly what we're seeing so far. Especially given the sharp disappointment in 10 a.m. U.S. ISM manufacturing data, which was about 10 minutes ago. You saw the dollar-yen accelerate lower. The dollar is doing okay. The yen is doing better. And that's a lot of what we've been talking about because it's, for all intents, or most intents, I should say, a safe haven currency. And not in the sense that everyone's looking for safety in the Japanese yen. Instead, everyone's already short, or a lot of people are short the Japanese yen against higher yielders, such as the Brazilian real, such as the Mexican peso, the South African rand, and so on. And that also extends to developed markets as well. You see things like Australia versus the yen and New Zealand versus the yen. So when the sun is shining, unlike today, the sun is shining, everyone wants to be short of yen because it has interest rates near 0%. And it's very cheap to borrow yen, at least it was up until last week, let's say, against collecting much higher yields in other markets. Well, the problem is now that we're seeing the yen is becoming a little too much for a lot of people to hold. When you see the clouds form and the snow and the rain start to come down, it's time to seek shelter or at least get out of the risky market that you're in. And in fact, I think that's exactly what we're seeing. So what I want to focus on right now is the fact that Forex volatility prices have jumped, favoring strong market moves ahead. It's fairly straightforward. If you've never followed along before, these daily FX volatility indices are measuring real Forex volatility prices paid and received via FX options prices. Now, why does it matter? Because it's kind of our best guess, or it is our best guess. Numerous white papers and a ton of research will show that volatility prices, as seen through options markets, are your best guess onto how much something will move. In this case, we're measuring volatility prices in major currencies. Well, right now, you see it especially on a short-term basis, but even the 3-month and 1-month prices are picking up quite a bit. 1-week volatility is now at its most expensive since about September 2nd, which, if you remember, is the week of the famous September FOMC meeting, the Federal Open Market Committee meeting, where it was heavily debated whether or not the Fed would start the so-called taper. There was a stupid nickname going around called Sep Taper, which is the easiest way to remember it. Well, they didn't, and the dollar lost a lot of ground, but that kind of emphasizes the risk to markets right now. That was a volatile week. This stands to be as volatile as of right now. Again, just because traders are betting on and hedging against big moves doesn't mean that they have to happen, but it's almost self-fulfilling to a large degree. I mean, if everyone thinks that it's going to happen, they're going to move in the direction of price. Oh, well, we might see continuation in these currency pairs. That's exactly what we want when it comes to specific trading strategies. And indeed, that's why the focus of this article and this webinar, for that matter, is what strategy, what market condition. Right now, I think it's fairly clear that we're likely to see big moves. So you're not going to want to trade strategies that do well in slow moving markets. It's just trying to fit a square peg in a round hole It's just not the way, at least not my experience, or even from an intuitive standpoint, that you do well in trading. Instead, we're favoring the strategies that will tend to do well when markets are moving. And in our case, my focus has always been on the Daily FX Plus trading strategies because those are the ones I know and I've watched trade since I started into FXCM, literally, well, okay, so in 2006. And I'd started a little bit before that. But for all intents, I've watched these strategies trade for about 7 years and change at this point. So obviously I'm far from omniscient, but I try and say, okay, based on my research, based on experience, which are the strategies that are in a better position to do well, which are in a better or in a poor position to do well. You know, they might do poorly. Right now, what you see here on the left chart, or the leftmost column on this table, is what I call the volatility percentile. So up here I showed you volatility prices across the board. This is concretely measuring volatility prices across the majors plus the Canadian dollar. Those are the big numbers. This is a granular number. I take that price on a euro option and I say, how expensive is volatility now as compared to the past 90 calendar days? That's approximately a quarter. 89 is Fibonacci number. The real truth that number back and forth as well, and that's why I use it. But right now, what we're seeing is, and that number ranges from 1 to 100. So if it's at 1, it means that volatility is really cheap. If it's at 100, it means that it's the most expensive it's been in at least 90 days. Right now, we're towards the top end of the spectrum. That means that we're going to position for big moves or strategies that tend to do well when markets are really moving. So euro, Swiss franc, New Zealand dollar, Canadian dollar, all of these currency pairs, with a minor exception in the dollar yen, for example. Remember, volatility, the big market moves, the financial market turmoil, tends to benefit both the safe haven U.S. dollar and the very risk averse, I should say, Japanese yen, or I would say Japanese yen is risk friendly because when stuff really hits the fan, that's when the Japanese yen tends to rally. Well, if the dollar does well in times of turmoil, as does the yen, you would expect that the dollar yen wouldn't be the biggest mover. And indeed, that's kind of what we're seeing. Whereas, you're seeing pairs like the Canadian dollar against the US dollar, or Australian dollar against the US dollar, and all these pairs against the yen. That volatility is expensive. Traders are betting on and hedging against big moves. That translates into breakout trading for me. And in concrete terms, breakout is when, all right, currency pair just broke to its highest high of the past n number of bars. We're going to buy into that rally. So you tend to buy at really bad prices, sell at really bad prices, with the expectation that the currency is going to continue in that direction. So, as you might imagine, most of the time that doesn't work. Buying at the worst possible price is not necessarily a great way to trade unless you have reason to believe that this is, it's expensive, but it's going to get more expensive. It's cheap, but it's going to get even cheaper. And that's kind of what we're watching for, or that is what we're watching for right now. Particularly in pairs such as Aussie dollar, even the sterling to a large extent, the Canadian dollar. Almost all of the yen crosses, I think, are in a good position to do well. If in fact this is the start of a much larger move, and this isn't the first time I say this, is what I've been talking about for the past 2, 3, call it 2 weeks. What I said was, look, if the yen really starts moving, then there's a good chance it's going to continue moving. And that's exactly what we're seeing so far. Now, there's no guarantee that that's going to continue happening. At the same time, though, I'd rather position myself for the higher probability trade, and in my opinion, that's the breakout trade. That's a continuation trade here. So in concrete terms, take a look at this report. And the best way to get a sense of what these strategies are doing, in my opinion, is to, you can check out this automate our SSI-based strategies via MirrorTrader free of charge. So what I'll do is log into MirrorTrader and just check out what the different strategies are doing. Doesn't mean you have to trade them, but just to give you a broad sense. So actually, my login is not saved onto this computer. So you'll have to, you know, take my word on it. But go ahead and take a look. Kick the tires a few times and let me know what you think. Robert says, this is a good webinar for traders. Appreciate the kind words, Robert. Ram says, good morning, David. Good morning, Ram. So there are no further questions. I'll start wrapping up here. But as always, I'm especially available on Twitter. Email tends to pile up fairly quickly. So to contact me or anyone else on the Daily Effects team for that matter, and you can find the rest of us right here on the real-time news page. Twitter is an excellent resource. It's free. It's just a great way to keep track of markets, especially when you have essentially what amounts to professional grade news service to a large extent. So check that out. If you'd like to subscribe to future email updates, sign up right here. About 3 to 5 emails a week. I already sent out my email from this morning, the report which I just showed you. Take a look at the report to which I've just linked that summarizes what I've been talking about for the past 11 or so minutes. So, guest asks, can you post a MirrorTrader URL, please? With pleasure. So, this URL will give you everything you need to know, and you can sign up for a practice account just to kick the tires for a while. So check that out. If there are no further questions, or if you think of anything later, contact me on Twitter. Best of luck trading. Have a great week. I'll be back online on Wednesday morning, but until then, I'll be on Twitter definitely, especially when markets are volatile. And we're probably going to see pretty big moves, so there's a fair chance that I'll be readily posting updates. Best luck trading, and I'll talk to you soon.